Our late friend Bill Niskanen, on the topic of transition, was known for the following remark. I'm not sure who he stole it from, but he said the river about a mile from the Niagara Falls may be a little bit calmer than the river about a mile above Niagara Falls, but the transition is a bitch. We need to think about whether the transition to a gold standard would similarly be a bitch, and if so, I mean, that would count in our cost-benefit calculus of whether going back to a gold standard or forward to a gold standard is worth it. So we need to consider what's the least bitchy way, is that how I should put it? The most cost-effective way of returning to a gold standard. So I'm going to just stipulate that we all want to return to the gold standard and ask what's the most effective way to do so. How do we get there from here? There are two transitional paths that have already been mentioned today that suggest themselves. One is to legalize a parallel gold standard. Ron Paul talked about that this morning. Let it grow up alongside the current fiat dollar regime. The more conventional path, as Dick Timberlake referred to, as the U.S. followed after the suspension of the gold standard during the Civil War, is to set a date after which the U.S. dollar is to be meaningfully defined as a certain mass of gold, so many grams of gold per dollar or so many dollars per ounce. That today would, of course, imply converting the Federal Reserve's liabilities into gold redeemable claims. Now, we see analogs of these two kinds of transitional paths when we observe how peso-using countries have dollarized. In particular, I have in mind two cases of about 10 years ago. In Ecuador, between 1998 and 2000, a parallel, unofficial U.S. dollar standard emerged as the inflation rate rose, as it went from low double digits to high double digits to triple digits. The private sector dollarized itself, and it was so dollarized that there really wasn't much change when the government finally pulled the plug on the official currency and Ecuador became officially dollarized. By contrast, in El Salvador in 2001, the government chose to permanently lock in the dollar value of the currency, which had been on a dollar exchange rate peg, by outright adopting the U.S. dollar, while inflation was still low and the local currency was still dominant. So to put it in a nutshell, when the official switch to the harder currency came in Ecuador, it was an act of necessity in the midst of a hyperinflation crisis. In El Salvador, it was an act of foresight to avoid such a crisis. And I'm going to say I hope we take the El Salvadoran path rather than the Ecuadorian path. By the way, if I seem a little sleepy, it's because I actually had dinner in El Salvador last night in the airport, en route from a university in Guatemala back here. It's a 4-hour flight from there to Dulles, so you can do the math. I'm a little sleep deprived. Let me talk a little about allowing a parallel gold standard. Clearing away the legal barriers to a parallel gold standard is fairly straightforward. It can be done without immediately altering existing financial institutions. Ron Paul this morning mentioned his H.R. 1098, the Free Competition and Currency Act of 2011, which represents one way to do that. It would ensure the enforceability of contracts denominated in units other than fiat dollars by removing legal tender status from Federal Reserve notes and Treasury coins. Secondly, it would remove taxes on gold and silver coins that Federal Reserve notes do not face. And third, it would remove sections of the U.S. Code that have been used to criminalize the victimless activity of privately minting distinctive pieces of metal intended to circulate as money. And whatever you think of Bernard van Nothaus's enterprise of trying to compete with the Federal Reserve System, issuing a silver-based currency, I think the injustice of making that activity illegal is pretty patent. Now, if these sorts of measures seem unprecedented, you should note that Federal Reserve notes didn't become legal tender until 1933. Bank of England notes are not legal tender today in Scotland or Northern Ireland. where private banknotes, also not legal tender, actually predominate in the currency circulation. You might also note that in Switzerland, the purchase and sale of gold is not subject to taxes such as value-added taxes or capital gains taxes. Now, I think further legal changes would be necessary to make a parallel gold standard really viable, namely changes to allow citizens who adopt the parallel gold standard to have access to gold-denominated banking services. I mean, paying using physical gold coins is kind of inconvenient. The world evolved well beyond that when it was on a gold standard. So banking services like the issue of gold redeemable checking accounts, gold redeemable paper currency notes, would be important. So either existing banking companies would have to be free to operate, bank holding companies would have to be free to operate separate gold-denominated subsidiaries, right, with their own balance sheets, or else new gold-based institutions would have to be free to open. And the case for doing these things, for leveling the playing field between the fiat dollar and other potential monetary standards, rests on the simple fact that consumers are better served by competition than by monopoly. Keeping alternatives to the fiat dollar at a legal disadvantage limits the options of American consumers, makes them worse off in that respect. Now, the option to use something other than the fiat dollar isn't nearly as important when the dollar is experiencing low inflation, as it of course will be if inflation becomes more pronounced. So we shouldn't really expect a mass switchover just from the legalization of a parallel gold standard, as long as inflation remains low. So in that sense, it's in the Fed's hands how much of a use people make of this option. And there's, of course, a strong incumbency advantage to an established monetary standard. There's a network property to a monetary standard. The greater the number of people using a particular monetary standard, the more advantageous it is for you to use it as well. Or to put it another way, you want to get paid in the stuff that other people want to get paid in. But we do see spontaneous dollarizations in cases where the peso becomes unstable. Right? So like the benefit of using dollars in a peso economy, the benefit of using gold in a dollar economy will increase as the fiat dollar's inflation rate becomes higher and more variable. And that's when if U.S. inflation returns to double digits, U.S. citizens would find it very helpful to have an alternative currency network available, already up and running, even if on a small scale. That kind of potential competition might, who knows, might even incentivize the Fed to keep inflation low. Let me turn to reestablishing a gold definition for the U.S. dollar. The fact that there is this network property to a monetary standard supports the case for not simply legalizing a parallel gold standard, but also reestablishing a gold definition for the U.S. dollar. Right? If network effects mean that switching over piecemeal in an uncoordinated fashion isn't going to happen until inflation really gets out of hand, there's a strong case for avoiding that kind of transitional crisis by making a coordinated switchover before high inflation takes hold. As I said, following the Salvadoran model rather than the Ecuadorian model. Now, when we reconsider the establishment of a gold dollar more than 40 years after the closure of the gold window, we have to pick a new parity. I think it's pretty widely recognized that it would be foolish to try to relink the dollar to gold at $20.67 an ounce, or even at $35 an ounce, or even at $42.22 an ounce. It would be foolish, of course, because the U.S. price level has risen more than fivefold since 1971. The real price of gold has gone up in addition, so $42.22 an ounce, or anything less, implies a massive deflation, a deflation not anticipated in current nominal contracts. Britain's painful deflation after the First World War, when they tried to go back on the old parity despite having massively inflated the price level, serves as a warning to us. What happened, the purchasing power of gold at the old parity was much lower in Britain than in the rest of the world, so gold flowed out of Britain, and pound sterling values faced inescapable downward pressure. It was a vicious deflation. I think that point is widely appreciated. Nobody advocates returning to such a low parity. But by similar logic, it would be foolish to declare a new parity of, say, $8,000 an ounce, 5 times the current price. The result in that case would be a sharp transitional inflation, and a very expensive importation, not an exportation like Britain suffered, but an importation of gold from the rest of the world. Right? Gold would rush in to take advantage of the fact that for 1 ounce of gold you could get $8,000, which buys a lot more at current prices than an ounce of gold buys. And that would go on until the influx of gold raised the U.S. price level to $8,000, to the point that $8,000 no longer buys more than 1 ounce of gold. So we'd like to avoid a transitional inflation or deflation, and the way to do that, if you follow the logic of what I'm saying, is to establish a parity something close to the current dollar price of gold. And I say close because there will be some change in the real demand for monetary gold following the stabilization of the gold value of the dollar. But there are two forces at work here. On the one hand, with lower expected inflation, the cost of holding non-interest-bearing money will be lower, and so the real demand to hold money in the form of non-interest-bearing balances, that is, currency or checking accounts that don't pay interest, will rise. On the other hand, with the risk of dollar inflation dramatically reduced, the demand for gold coins to hedge against dollar inflation, right, the demand for Krugerrands and Eagles and bullion, that will fall dramatically, right? The mirror image of the way it's risen in recent years. I think that latter effect is likely to dominate because hedging demand is the main reason why the real price of gold is now higher than it was when the U.S. abandoned the gold standard, the last vestiges of gold redeemability in 1971. Okay, so suppose we think about going back to gold at $1,600 an ounce or something like it. Does the U.S. Treasury own enough gold to do that? And the answer is yes. At a market price of $1,600 per fine troy ounce, the U.S. government's 261.5 million ounces of gold, assuming it's all there. I realize Fort Knox hasn't been audited in a while. Those gold holdings are worth $418.4 billion. Is that big enough? Well, look, current required bank reserves are only $83 billion. So it's plenty compared to that. Or look at it another way, $418.4 billion is just about 20% of current M1, the sum of currency and checking account balances. Right? 20% is a more than healthy reserve ratio by historical standards. So combined with the likelihood that hedging demand will shrink by more than banks' reserve demand will grow with larger demand for M1 balances, I expect that denationalization and remonetization of the U.S. bullion stock at the current price would actually allow the U.S. economy to export some excess gold. There'll be a small transitional windfall for U.S. citizens getting imported goods and services in exchange for the excess gold. So expeditiously establishing a new gold definition for the U.S. dollar requires the following two steps. One, withdraw most of the $1.6 trillion in non-required reserves that banks have accumulated since September 2009 by eliminating interest on reserves and by selling the mortgage-backed securities that the Fed acquired in QE1, plus enough treasuries, to bring the total of bank reserves down to the value of the U.S. government's gold stock, somewhere around $400 billion. Second, redeem Federal Reserve liabilities with the U.S. government's gold at the then current market price. That would put us on a gold standard with plenty of reserves. Now, I say plenty of reserves assuming that 20% is plenty by historical standards of fractional reserve banking systems. But there is, of course, the point of view, which has been mentioned in Ron Paul's talk and in other places today. There is the idea that we should establish 100% reserves behind M1. I mentioned $8,000 as a figure a minute ago. $8,000 is about what you get if you divide current M1 by the stock of gold ounces held by the Fed. Some economists who favor 100% reserves for currency and checking accounts have offered this as an approach to finding the new parity, just perform this division. Never mind what the world price of gold is. But it's so much above the world price of gold that, as I said, it implies a huge influx of gold for the rest of the world, a large loss of U.S. wealth in exchange for the imported gold, and a sharp transitional inflation. I think we can do better than that. To put it another way, to establish 100% gold backing for currency and checking accounts would be very expensive. At $1,600 per ounce, the difference between M1, which is about $2.1 trillion, and the current stock of gold held by the federal government, about $400 billion, as I said, well, you can do the math. That's $1.7 trillion. That's a pretty expensive proposition. American taxpayers would have to buy $1.7 trillion worth of gold. Something else about 100% reserves should be mentioned, which is they make it impossible to have what was historically the most popular sort of currency, namely circulating, redeemable paper notes. If you're going to put all money on a warehouse basis, it's impossible to have circulating bearer anonymous currency because the warehouse doesn't know who has it. They can't charge storage fees. And gold warehouses have to fund their operations through storage fees. So it's not clear how you would have circulating warehouse receipts. What about the central bank? Well, because the nation's stock of money becomes endogenous under a gold standard, no monetary policy is needed. And as I like to do, I quote Alan Greenspan on this when he was on The Daily Show. He said, "You didn't need a central bank when we were on the gold standard. All the automatic things occurred because people would buy and sell gold and the market would do what the Fed does now." Okay, not put exactly the best way, but what he's saying is that we didn't need a Federal Reserve in 1913 to manage the stock of money, and of course the Federal Reserve Act didn't actually conceive of the Fed as a day-by-day manager of the money supply. The gold standard was supposed to manage the money supply. If you retain a central bank to manage the money supply, you actually undermine the automatic operation of the gold standard. You damage the credibility of the dollar. You undermine the pre-commitment to the rules of the game because you've established a discretionary actor with the power to void the rules of the game. So it does more harm than good if you understand the logic of pre-commitment, the importance of pre-commitment to sound money. Central banks invariably face political pressures to pursue monetary policies inconsistent with redemption of gold at a fixed rate. And on the question of a dual versus single mandate that came up earlier today, the European Central Bank has a single mandate. It has a very strongly worded constitution that makes price stability its single mandate. It hasn't held up. Right? When push came to shove and the European Central Bank was asked to monetize the debts of the Greece and Spain and Portugal and Ireland, it's been caving in, and inflation in Europe is just as high as in the U.S. It's running around 4% year over year. So when a central bank runs a policy inconsistent with maintaining the gold standard, as it will be pressured to do, the historical evidence is that the gold standard gives. By contrast, a system of competing private banks issuing gold redeemable liabilities faces legal and competitive constraints, and those kind of banks actually have a better track record at maintaining convertibility than central banks do. What we call the classical gold standard, it's sometimes forgotten, functioned quite well without a central bank in many countries, like the United States, like Canada, like Australia, like New Zealand, like South Africa, particularly in Canada, which didn't weaken its banking system with ill-advised legal restrictions. Even in the United States, which had severe financial panics, those panics could have been avoided if we had followed the Canadian banking model. Canada didn't have those panics. So I blame those on the bank regulatory system, not on the gold standard. But even given all that, the business cycle wasn't worse under that system than it has been under the Fed's watch. Footnote to a paper George Selgin and Bill Lestraps and I have in process. Do we need a central bank for some other purposes under a gold standard? Well, we don't need a central bank to issue currency. Private banknotes form the majority of circulating currency before the Federal Reserve Act. The Fed has some other useful functions that can be returned to private clearinghouse associations as they were before the Federal Reserve Act. Clearing and settlement of payments, enforcement of membership standards for solvency and liquidity, and conceivably lender of last resort operations in the sense of organizing loans of reserves from banks that have enough to banks that are running low in unusual cases. So I think it's a pretty straightforward case, but let me contrast what I'm saying to something the journalist Martin Wolf recently wrote. He said the obvious form of a contemporary gold standard would be a direct link between base money and gold. Base money would be 100% gold-backed. The central bank would then become a currency board in gold with the unit of account defined in terms of a given weight of gold. Well, you can have the definition without having a currency board that is a 100% reserve arrangement. And actually, although central bank notes are base money today, under a gold standard they're not. Only coined gold and bullion is base money under a gold standard. Notes in circulation are redeemable liabilities of their issuers. They're not actual bank reserves. They're not potential bank reserves. And although a currency board is less likely than a central bank to undermine the gold standard, there isn't any need for it either. Surprisingly, Wolf actually recognizes that it's wasteful to hold 100% reserve in a bank if depositors don't need their money almost all the time, but he doesn't draw the obvious conclusion, which is that a currency board in gold is less efficient than fractional reserve banking under the gold standard. So the banking system would be more robust than he suspects, given the historical evidence I've cited. And we want to return, if we want to return to a gold standard, it should be one that doesn't unnecessarily require expensive gold holdings and doesn't introduce a central bank able to avoid the rules of the game, and of course, even better if we take on the task of reforming our banking system so that it doesn't rely on legal restrictions and doesn't rely on subsidies and guarantees. Thank you.